Hey, welcome to the 40 Finance channel, everybody. I've been digging through the stock screeners over the past couple weeks here, just looking as we head into the end of the year on where things stand in terms of valuation and growth prospects for 2023. And what I've put together here today, it's a pretty intriguing list, okay? And it's only about 8 stocks. And this list comes together after sorting through hundreds and hundreds of stocks, mostly large and mega cap stocks. Again, since we're kind of in treacherous territory here, I'm looking for bigger stocks and profitable stocks, ones that have an actual EPS or they're expected to grow into an EPS in 2023. And what I was looking for on the valuation side is stocks that are trending below their 5-year average in terms of forward PE. And then I'm also, at the exact same time, looking for stocks that are trending above their 5-year average for revenue growth. Okay, so stocks that are, at least compared to themselves, historically cheap, and then again, compared to themselves, historically growing beyond their 5-year average. And all these things, of course, are based on projections, so they can change. We're working off revenue projections and EPS projections looking ahead to 2023. But when you kind of take into account how negative the market is right now, at least from a sentiment perspective, I'm sort of banking on the fact that a lot of analysts have retracted their projections up to this point. You know, now that we're in December of 2022, we'll have a much more concrete view, I guess you could say, in January, February, early March, when we get our next quarter's earnings and the CEOs are sort of on the hook to provide some guidance there at the beginning of the year. Now, everything you see on the screen here today is from my favorite stock market research platform, Seeking Alpha Premium, and they have extended the $99 sale through the end of the year. So that's $99 for full access to Seeking Alpha Premium for 12 months. Okay, this isn't $99 a month. This is $99 for the next 12 months, which is an amazing deal. I wasn't sure it was going to extend into December, but it looks like it has. And I guess that's one of the good things in a down market is you get awesome, valuable services like Seeking Alpha, and you see some incredible sales, not only in stocks, but some of the best tools in the industry like this one. My affiliate link is in the description if you're interested in supporting the channel. Thank you very much. And you do get a free subscription, or excuse me, a free trial, 7-day free trial on the front end before they charge your card. So check out that link in the description. Okay, now before we jump into this list, I'll let you know how I got here. So first of all, I have the Save Screener in Seeking Alpha that you can see what I've titled it, Large and Mega Cap USA with Revenue and EPS Growth looking ahead to the next year. So it's only stocks that are in the United States or their headquarters are in the United States. It can include companies that do business internationally, but they're just based here. Market cap from 9 billion up to over 10 billion. So basically large caps, you know, technically those start at 10 billion, but I put the 9 in there in case there's swings in the market that, you know, take a company from large cap down to medium. I just use 9 billion. Then you've got PE non-GAAP looking forward. Okay, we want to at least insinuate a profitable company. So we have a minimum score on the forward non-GAAP PE. And then revenue looking ahead, we want a minimum of 5% revenue growth looking ahead forward up to infinity, right? Over 40%. So the company does need to be growing in order to hit this stock screener that I've got set up. Now you can see here with the results from the screener, there's 434 companies or stocks in here, right? And we're just going to click through 8 of them. So when I'm talking about an exclusive list, this 434 satisfies all of these requirements, which is quite a few companies. So if we go to this growth tab, if it loads for me here, there's plenty of companies, you know, revenue forward looking that do better than plus 5%, right? So you got Moderna in here, Enphase, Tesla, Datadog, etc. But the key is looking at each of those names and comparing it to itself over the past 5 years. Okay, so we know that, for example, Tesla is still growing, right? But is the top line and bottom line growing at a better pace? Is the projection at a better pace next year than it has been over the 5-year average? So there's a lot of subtleties to this filter, and that's why there's really only 8 names that I could come up with. Now, in order to get the 8 names, to be fair, I had to click on a lot of different stocks and look at them, so I'm sure there are others. There was just really no way to filter this out in the stock screener the way that I wanted to. All right, so let's jump into the 8 names. First on the board here is Booking Holdings. Booking Holdings. All right, now travel stocks here very, very recently have been under some pressure as a lot of the big banks have come out and said, we don't think travel is going to be very profitable next year, or certainly not mimic what it went through this year. But from a projection standpoint, at least for Booking Holdings, who, by the way, is not just airfare, it's hotels and rentals and things like that, the numbers look pretty good when you compare it to Booking Holdings itself. Okay, so if we go to growth, let's go to growth first of all. And revenue growth looking forward for the next fiscal year, 41% is the projection. Their 5-year average here on Booking Holdings is 10%. So significantly more projected. So even if this came down 10% or hell, even 20%, you'd still have revenue growth forward that is above the Booking Holdings 5-year average. Now, that's on the top line. What about the bottom line? So EPS diluted growth forward, 197% next year, coming off of a year that was 548%. So, some of that obviously is going to play into the COVID equation, but keep in mind this forward one is for next year, so it compares to 2022. Right? So it's not like it's comparing to 2020 when flights were grounded, et cetera, et cetera. And if you look at the 5-year average for Booking Holdings, plus 36% EPS growth, they're going to blow that away. So the growth looks really good. What about the valuation, right? So a lot of people can do growth or replicate growth, but can they get the bottom line to match up? Well, if we go to non-GAAP forward PE, coming in for Booking Holdings at a 20, which is projected for the end of this year, their 5-year average is about a 47. Okay, so that's 57% cheaper, at least from the multiple line. And then if you want to get into some other numbers, price to sales, let's do price to sales forward, 4.48, that's 37% less than their 5 years average. And not all stocks do this, but they do have a calculation here. Forward price to cash flow, 14.56, significantly lower than what others have paid for Booking Holdings. All right, next stock on the board is Chipotle. And Chipotle, despite all of its monster growth, if we look at revenue growth forward, 18.18%, that is 40% higher. The forward-looking projection is 40% higher than what CMG has done in the past at about 13%. Then if we go to the bottom line, and we are looking for, where is it here? EPS diluted growth forward, 59% EPS growth projected. That is just below the CMG average at 59.98%. So barely snuck in this category, and that's how close these things can go. But the CMG coming in there, at least with the revenue growth, trending higher than the 5-year average. Now, what about valuation in terms of what you would pay today at $1,530? PE non-GAAP forward right now is at a 45. The 5-year average for CMG is 63. Okay, so we're not seeing necessarily exponential growth on the bottom line, but you are seeing higher growth on the top line, and let's just call it consistency with EPS growth. And of course, that could even still go up. If projections are wrong, it could also go down, obviously. But what you've got to ask yourself from a value standpoint, CMG over 5 years, running about a 63 forward PE. Right now, you get a 29% discount, at least to that multiple. Now, given we are in, again, the treacherous time for stocks, and you should get a little bit of a value tick when you're shopping right now, and you certainly get one with CMG. Let's take a look at price to sales going forward. This one's a little bit higher, 4.81 versus 5-year average of 4.4. But price to cash flow, looking ahead, 32 times is below the 5-year average of 34 times that it's been seen. So CMG just squeaking in there, but it does tick both boxes of value and growth that I was looking for in this exercise. All right, next up we've got Disney. And Disney has been in the news a lot with the returning CEO. It should be a very interesting story. Revenue growth forward, 13.3% is what the projection is right now. 5-year average for Disney, 9%. So it's a 47% uptick in revenue growth rate, okay? And if we go down to EPS diluted growth forward, plus 32, almost 33% this year. Disney normally comes in with about a 7% EPS growth. So you definitely tick both boxes on the growth, top and bottom line. What about valuation? P non-GAAP forward is a 22. Disney typically is running in the 40s on forward PE over the past 5 years, so huge discount there. And I think eventually, because they had some troubles in the bottom line on the COVID days, we'll start to be able to compare the PE gap forward a little bit better, but right now it is under 30. Looking at things, price to sales going forward, you're under 2 at 1.84, minus 43% off the 5-year average. And price to cash flow, that looks a little high, 54.69, and it is. 25.02 is the 5-year average. So there might be some things to look at there. So with Disney, you do have a little red flag that doesn't quite fit the criteria here, although that is on cash flow metrics, which are generated slightly differently. So just investigate that before you would jump in on this one. All right, Fortinet, thinking about cybersecurity and how much cybersecurity came into play, particularly with the international tensions that are going on. I'm keenly investigating cybersecurity stocks because it's just hard to imagine that the top performers, whether it's CrowdStrike, Fortinet, names like that, it's just hard to imagine there's not a need for their services growing each year. Fortinet is nice if you're a traditional sort of value-based investor because it actually has an EPS. It doesn't grow as fast, but even with that said, revenue growth forward, 27.6. The 5-year average for Fortinet, 19%. So you're plus 44% in that category. As far as EPS diluted growth, looking ahead, 27%. That is very slightly above the growth that it's had over the past 5 years, just below 27. All right, so Fortinet outperforming their own 5-year average. Let's look at our valuations. PE non-GAAP forward, which I'm guessing is what they report on, 44.79. It's about a 10% discount to the 5-year average of 49. If they do get into GAAP, the GAAP forward is 51. And the 5-year average has been 66. So that's a 23% discount from what you've seen over the past 5 years on this particular stock. When we go price to sales forward, 9.1, that is slightly higher than the 5-year average, but just barely, 8.93. And we talked about price to cash flow forward, 24.6 times. That is just a little bit higher than we've seen on the 5-year average. But if we're just going to go on revenue growth and bottom line EPS, Fortinet hits both boxes. All right, next up we got Mastercard. Revenue growth forward, 18%. 5-year average, 13% for Mastercard. EPS growth looking forward is just about 24%. 5-year average is 19%, so that's a 25% improvement if they do hit their projections. Now, what about valuations compared to the past 5 years? P-GAAP forward, Mastercard should be reporting in GAAP. We've got a 34. 5-year average here is 37.6, so that's a 10-ish% discount to what it is traded for over the past 5 years. Price to sales forward is at 15. It's typically in the 16.5 range, so that's another, call it minus 9%. And then cash flow, 30, call it 32 times. Mastercard typically trading at 36 times, so you get a 12% discount on that metric. And this is going to be an interesting time for Mastercard and Visa with, the legislation coming out, the discussion of the legislation coming out on, how they get their fees and sort of the four-walled world that they play in. My take on it is it's bad press for Mastercard and Visa, but I really don't think in the long haul, these are such behemoths. I really don't think that it makes that big of an impact, certainly not in year 1 or year 2. All right, how about EPAM Systems? Forward revenue growth, almost 29% projected. 5-year average, 24 or so, that's plus 18%. Then EPS diluted growth looking forward, plus 25%. 5-year average of 22. So they are exceeding their 5-year average on both forward EPS and forward revenue, which is good. But what about the valuation? How expensive is EPM Solutions compared to the past? Well, if we go PE GAAP forward of 51, that is 3% higher than it has been over the past 5 years. I think that this company might report in non-GAAP. That's something that you just have to look at. If they do come in at non-GAAP, then they are actually 24% less than their 5-year average. So it just depends on which way the street looks at their numbers on the EPS line. As far as the sales line, price to sales forward, coming in at 4. Their standard over 5 years has been over 5, so about a 23% discount there. Price to cash flow forward, 37.5. The standard over the past 5 years has been in the 43, 44 range, so you get about a 14% discount on EPM Solutions on forward price to cash flow. All right, last one on the board, Five Below, the chain of discount stores. Revenue growth forward, plus 22%. 5-year average is 20.84%. So they're sneaking in just above that line on the revenue growth. EPS diluted forward, plus 36%. The average is just about 25%. So you're getting a 42% discount on that growth metric there. But what about valuation? All right, let's take a look. Non-GAAP PE projected to come in about 38. 5-year average is 43. Okay, now if they do report in GAAP, it's right about the same, 38.85. 5-year average doesn't really change either, 43.45. So about a 10% discount right now that we're seeing over the past 5 years. Let's take a look at price to sales forward, 3.25, just barely under the 3.51. And price to cash flow looking ahead, 34.53. That is actually above ever so slightly the 5-year average of 32.91, a difference of almost 5%. All right, guys, so there's those 7 or 8 names out there that at least from a performance to their own stock's history, look like they may offer some value. All of them are arguably cheaper from a multiple perspective over the past, at least compared to the past 5-year average. And all of them are growing at least slightly faster than their past 5-year average. So call that the sort of mad scientist list that I put together there after clicking through dozens and dozens and dozens of stocks. Hope that you enjoyed it. If you want to set up stock screeners like this, don't forget to check out that Seeking Alpha special offer and my affiliate link in the description. Hope everybody's doing well. We'll see you on the next video.